Hello everyone, welcome back to the channel. Today we're diving deep into the October 15th 75 rule and exploring essential investment accounts and strategies. Let's get started. Alright, let's break down this October 15th 75 rule, starting with the foundation, the 75%. This chunk of your income is dedicated to your essential living expenses. We're talking about keeping a roof over your head, food on the table, transportation, the non-negotiables of daily life. Now, this doesn't mean you have to live on ramen noodles and never leave the house. It's about being mindful of your spending habits and making conscious choices. Think about it. How much are you spending each month on things you could potentially cut back on? That daily latte, the subscription services you barely use, those little expenses can add up. The goal here is to find a balance between enjoying your life and living within your means. It's about creating a sustainable budget that allows you to cover your essential expenses comfortably without feeling strapped. Remember, this isn't about deprivation, it's about setting a solid foundation for your financial well-being. Let's be real, sometimes life throws curveballs, unexpected expenses pop up, and you might need to adjust this percentage slightly. The key is to be flexible and adapt as needed. Maybe you cut back on dining out for a few months to accommodate a car repair. The point is, having a clear understanding of your essential expenses gives you a solid starting point for managing your money effectively. This 75% category can also include things like debt repayment. If you're carrying credit card debt, student loans, or any other kind of debt, allocating a portion of this 75% towards aggressively paying it down is crucial. Remember, high-interest debt can be a major roadblock to achieving your financial goals, so prioritize getting rid of it as quickly as possible. This 75% is all about creating that financial stability, ensuring you're covering your basic needs and managing debt responsibly. So, take a close look at your spending habits, identify areas where you can potentially cut back, and start building that solid financial foundation today. Now let's talk about the 10% rule, the part of your income that you're setting aside for your future self. This is where the magic of compound interest really comes into play. Think of it like planting a seed. The earlier you plant it, the more time it has to grow and flourish. This 10% should be directed towards your savings and investments. Now I know what you're thinking. Saving 10% every month seems impossible, right? But trust me, it's more attainable than you might think. Even small amounts, saved consistently over time, can add up to significant sums thanks to the power of compound interest. Imagine this, you start investing $100 a month at a 7% annual return. After 30 years, you'll have over $100,000. That's the beauty of compound interest. Your money is essentially making money, and those earnings are reinvested to generate even more earnings over time. This 10% is your safety net, your financial cushion for unexpected events. It's about creating a sense of security, knowing that you have funds available for emergencies or unexpected life events. Whether it's a sudden job loss, medical bills, or a car repair, having that financial buffer can make a world of difference. But it's not just about emergencies. This 10% is also about building long-term wealth. It's about investing in your future, whether that's buying a home, retiring comfortably, or achieving financial independence. By consistently setting aside this portion of your income, you're taking control of your financial destiny. Now, where you choose to invest this 10% is a personal decision. We'll delve into specific investment accounts and strategies later on, but the important thing is that you're making a conscious effort to grow your money over time. Remember, consistency is key here. Small, consistent steps over time can lead to remarkable results. Alright, let's move on to the fun part, the 15%. This portion of your income is all about enjoying life, pursuing your passions, and investing in yourself. It's about finding a balance between financial responsibility and living a fulfilling life. This 15% is your guilt-free spending money. Want to take that weekend trip? Go for it. Been eyeing a new gadget or want to sign up for that cooking class? This is the category to fund those desires. Life is meant to be enjoyed, and this allocation ensures you're not just surviving, you're thriving. This category can also include things like personal development and education. Want to learn a new skill, take a course, or attend a conference that could boost your career prospects? Investing in yourself is one of the best investments you can make. This 15% is about recognizing that life is about more than just paying bills and saving for the future. It's about creating memories, pursuing your passions, and living a life that aligns with your values. It's about finding joy in the present moment while still planning for a secure future. The key is to spend this money on things that truly bring you joy and add value to your life. So whether it's a weekend getaway, a new hobby, or simply enjoying a nice dinner out with loved ones, embrace this 15%. Life is a balance, and this allocation ensures you're not just financially responsible, but also living a life filled with joy, purpose, and experiences that enrich your life. Now that we've covered the October 15th 75 rule, let's dive into some specific investment accounts and strategies, starting with two powerful tools for retirement savings, the Roth IRA and the 401k. Let's start with the Roth IRA. This is a retirement account that allows your investments to grow tax-free. That means when you retire and start withdrawing money from your Roth IRA, you won't owe any taxes on those earnings. It's like getting a bonus from the government for saving for retirement. The Roth IRA has annual contribution limits, so you can't just put an unlimited amount of money in there. However, the beauty of starting early is that you have more time for your investments to grow tax-free. Even if you can only contribute a small amount each month, the power of compound interest over time can lead to significant savings. Next up, we have the 401k. This is another retirement savings plan that's typically offered by employers. The beauty of the 401k is that your contributions are automatically deducted from your paycheck before taxes are taken out. This means you're essentially saving money before you even see it, making it easier to stick to your savings goals. Many employers also offer what's called a 401k match, where they'll contribute a certain percentage of your salary to your 401k account if you contribute as well. This is essentially free money, so if your employer offers a match, it's crucial to contribute at least enough to take full advantage of it. Both the Roth IRA and the 401k offer tax advantages for retirement savings. The best option for you will depend on your individual circumstances, such as your income level, tax bracket, and when you plan to retire. Now let's talk about where to invest your hard-earned money. While there are countless investment options out there, one strategy that I often recommend, especially for beginners, is investing in the S&P 500, which is a stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. Investing in the S&P 500 is a great way to gain exposure to a diversified portfolio of stocks without having to pick and choose individual companies. It's like investing in a small piece of the entire U.S. economy. One of the main advantages of investing in the stock market, and the S&P 500 in particular, is the potential for long-term growth. Historically, the stock market has delivered an average annual return of around 10%, which is significantly higher than the returns you're likely to get from savings accounts or bonds. Of course, it's important to remember that the stock market can be volatile in the short term, and there's always the risk of losing money. However, by investing for the long haul and riding out any market fluctuations, you're giving your investments the best chance to grow over time. Another benefit of investing in the S&P 500 is its simplicity. You don't need to be a financial expert or spend hours researching individual stocks. You can simply invest in a low-cost S&P 500 index fund, which is a type of mutual fund or exchange-traded fund, ETF, that tracks the performance of the S&P 500 index. Index funds are a popular choice for investors because they offer low fees and provide instant diversification. They're a great way to passively invest your money and participate in the long-term growth potential of the stock market. By investing in the S&P 500, you're essentially hitching your wagon to the long-term growth of the U.S. economy. There you have it, the October 15th 75 rule, a blueprint for taking control of your finances, building a secure future, and still enjoying the journey along the way. Start small, stay consistent, and don't be afraid to seek guidance along the way. Thanks for watching, and I'll see you in the next one.